An index that measures the volatility of the US stock market, that is called the VIX, surged by 74% in a single day last week. This is the second highest single day surge in the history of the VIX index, going back to 1990. In just 1 hour, Federal Reserve Chairman Jerome Powell completely shook the US stock market. If we add the S&P 500 to this chart, we see the stock market move down by 3% in just a day. Is this spike in volatility marking the beginning of something much larger? Like the volatile periods from 2020 during the pandemic and 2008 during the Great Financial Crisis? Both of these periods of volatility took the stock market down by over 30%. Or was this just another temporary spike in volatility, like all of these instances here that coincided with short-term market bottoms? What's interesting about today's spike on the VIX is that we actually saw it move up by more than 60% within a single day. Going back to 1990, this has only happened 4 times before. These happened on February 27th, 2007, February 5th, 2018, January 27th, 2021, August 5th, 2024, and today. Now, when we look at how the stock market performed after these big fear spikes, we see something interesting. In 3 out of the 4 previous episodes, 2018, 2021, and August 2024, stocks recovered completely within just 1 week. And in every single case, the market was trading higher 1 month later. So in many cases, these spikes in volatility have been opportunities to buy the dip. Nevertheless, we should remain cautious about ruling out a larger volatility spike. As we saw with the February 2007 reading, the price to pay is much too great to ignore the possibility of additional volatility. One indicator we can look at is something called the MOVE index. We can overlay it on top of the VIX and see that most of the time these two track each other very closely. The MOVE index measures the volatility of the bond market, so it's basically the same thing as the VIX, but for bonds. If we zoom in on what's been happening to the MOVE index during this recent stock market volatility, we see that it hasn't really been spiking much. That means that bond traders aren't showing nearly the same level of panic as stock market traders. During real market stress, like in March 2020, we generally see both the VIX and MOVE spike at the same time. As you can see, the MOVE index even began rising well in advance of the VIX back in 2020. Or during the 2008 financial crisis, the MOVE exploded as bond market liquidity dried up. So today, while stock investors are panicked about that 74% VIX spike, bond traders, who are often considered to be wiser decision makers than stock market traders, remain relatively unconcerned. But maybe stock traders are the ones that are right this time around. Maybe the MOVE index isn't reflecting reality and is about to catch up to the VIX. In fact, interest rates in the United States have been spiking recently, which could be a dangerous development for the stock market. This is the 10-year interest rate on US Treasury bonds. And we can see that more recently, it's been moving quite rapidly. The rate jumped from 4.1% to 4.5% in just a few weeks since early December. While a 0.4% increase might seem small, it's actually a big move for interest rates, and quite often, moves higher in Treasury yields lead to market volatility. If we add the S&P 500 to this chart, we can identify 3 corrections in April of 2024, October of 2023, and February of 2023. In each case, rapidly rising rates sparked these market sell-offs. But these yield-driven corrections actually proved to only be temporary setbacks within the broader bull market trend. Now, if we extend our chart back to 2022, we can see that rising rates can actually inflict much more serious damage to stocks. During this period, the 10-year yield surged from 1.4% to 4.3%, effectively tripling. This wasn't just a quick spike like in 2023. It was a sustained rise in yields over a full year that drove the market into a long downturn. So, could yields continue rising and drag the S&P 500 down over the next couple of months, similar to 2022? If we look at the price of oil against the 10-year yield, while most of the time these two are correlated to each other, right now we are seeing a divergence building between the two. The relationship between oil and the 10-year yield makes sense. Rising oil prices often signal broader inflationary pressures, which in turn drive yields higher. In 2022, for example, oil prices surged above $120 a barrel, fueling inflation concerns and pushing yields higher. But today's environment is very different. While yields have spiked from 3.6% to 4.5%, oil has actually remained more or less flat. This is a big divergence. The fact that oil prices aren't confirming the move in yields suggests that the yield spike likely isn't being driven by economic pressures or inflation concerns. The Federal Reserve, the United States central bank, controls short-term interest rates, and these can also have a great influence on all other interest rates in the economy, including the 10-year yield. If we look at a chart of the 10-year yield going back to the 1970s and add the federal funds rate, the interest rate that the Fed directly controls, we see how these two rates tend to move together over time. Over the past 18 months, the Fed has shifted from aggressively hiking rates to pausing and recently cutting rates. This downward trajectory led investors to believe that many more rate cuts were coming, essentially betting that the Fed would significantly lower the federal funds rate throughout 2025. This expectation of lower rates was pushing the 10-year yield down, but something happened last week. Jerome Powell expressed caution regarding the possibility of future rate cuts. Back in September, the consensus was that the Federal Reserve was going to do 6 25 basis point cuts, which would have taken their rate below 3% by the end of 2025. Following Powell's recent remarks, the market is now only expecting one rate cut by the end of 2025. That's a pretty big readjustment in expectations, and this is very likely what has been pushing the 10-year yield higher and the stock market lower. But we need to step back and look at the bigger picture of the price action. Right now, despite this dramatic spike in volatility, the bullish structure remains intact. The S&P 500 is still trading above its major moving averages. For this to turn into a real technical breakdown, similar to what we saw in 2008, we'd need to see the market slice through its key moving averages with conviction, and most importantly, these moving averages would need to start rolling over and trending down. Looking back at 2022, you can see exactly this type of deterioration playing out. The market dropped through its moving averages, followed by failed attempts to reclaim it, and then each moving average gradually rolled over, confirming the shift from bullish to bearish structure. But we're not seeing anything like that so far. The moving averages are still trending higher, and the market remains in its bullish uptrend channel. We'll continue to keep you up to date every step of the way. Thank you for watching.